Let's get started. Fabian from Marley Spoon, CEO, obviously experiencing some strong tailwinds with the recent crisis, but you're going to give a good backdrop and intro to the business first, and then get onto that. But thanks very much for joining us, as it is different hours in New York, and it's pretty crazy times over there. So I'll hand it over to you. Thanks very much.
Sure, thank you. Thanks for having me. So I'll talk a little bit about the company in intro, what we're doing. Maybe also give you a perspective on where the company was at prior to coronavirus, like 2 or 3 weeks ago, and then I'll talk a little bit about what we're seeing here. So my name is Fabian. I started Marley Spoon 5 years ago, 5.5 years ago, and so at Marley Spoon we bring delightful, market fresh and easy cooking back to the people. We want to make it easy for people to cook, because when you think about it, you walk in a supermarket and you're seeing all the fresh ingredients there in front of you. You could cook anything you like. But when you leave the supermarket, it's interesting, like for me, I always ended up cooking the same 2 or 3 things, like steak with broccoli, steak with green beans, always the same stuff. So we felt like, hey, why can't we make it easier? Why can't we make it easier for people to cook? So what we do is we make it easy to cook something, I don't know, like a saltimbocca with sugar snap pea, polenta mash. I don't know when you cooked the last time this at home, or a chicken supreme on a lentil bed. So our customers cook like this every night. Make it very, very easy so they can have an amazing dinner at their home. So how are we doing this? Well, first we have chefs that create recipes, and we have 27 recipes every week for you to choose from. Every week they change. So you just simply select what is it you like, and we have something for every taste, for every, whether you have kids, whether you want to be vegan or vegetarian, for every dietary preference, we have an amazing menu. So you just select what you like, how many portions you need, how many times per week you want to cook. And then we send a box to your home with all the fresh ingredients, everything you need. The only thing you need is salt, pepper, and oil. Everything else we ship to you. And people love it. They love it for various reasons. Of course, it's great to cook for your family and not always cook the same stuff. It's also great that you don't have to think about what are we going to cook tonight. Many people have so many other things in their head to think about. But also, especially in these times, people really like this concept of the food comes to me in a convenient way. It doesn't go to the public. It comes to me from a controlled environment, and it's safe, it's convenient, and I can make sure I cook something for my family and provide for them. That's what people really love about the service. Now, we compete with supermarkets, but we're very different from a supermarket. Now, a supermarket, as you know, like any retail business, they source the stock, and then they sell from stock, which is a problem because all the stock that waits for you perishes over time, which, by the way, creates a lot of waste, which is costly. Our business is very different. So don't think about us like a supermarket. Think about us more like a manufacturing business. So we are like a Procter & Gamble, a Unilever. We manufacture a consumer-branded product. But unlike these guys, we don't ship it into the retail sector. We go direct to consumer. And that has a profound impact on the supply chain. It flips the supply chain around, and it allows us to manufacture to order, to source to order. Meaning when our customer selects the box 6 days prior to delivery, that's when we know what the customer wants, and then we actually just have to buy what the customer needs. So our supply chain is a source to order supply chain, which, by the way, reduces all the waste, which is has a tremendous impact on the margins and profitability of the business, which we'll get to in a second. So when you think about it, we have customers that select the recipes, and this selection tells us about what they like. So we have all this data. We collect data over many years. We collect data on taste profiles and preferences. This allows us to have the perfect menu that customers want to have. Based on that, we source our products from the farm directly, from the producer directly, or from wholesale. Most of our supply chain is a local supply chain. And then we get these products delivered directly into our own facilities where we manufacture or assemble our products. And then we have third-party logistics that then send the product out to our customers. So that's our supply chain. It's very different from a supermarket. And because of the supply chain differences, we also have tremendous advantages compared to supermarkets. First of all, unlike a supermarket that doesn't know what you want and therefore has to put everything in their stores, on average, a supermarket has 25,000 SKUs on average. At Marley Spoon, we know actually what customers want, and we just select out of the pantry of 800 items, and any given week, not more than 200 items. So our SKUs that we need to craft these 27 options it's actually much easier to procure as there's much less SKUs. We really compress this. You only need 2 or 3 chicken cuts to create an enormous amount of recipes. You don't need really this long tail of SKUs. That's a big advantage. The second big advantage, we don't have the retail footprint. Now, for example, in the United States, there's a company called the Kroger Company. They have 3,500 supermarket locations to cover 60% of the US population. Now, Marley Spoon in the US, we can cover 92% of the US population out of just 3 facilities. So the benefit of our business model is it has a much reduced footprint where we can globally today service 180 million households. That's the reach that we have. That's the amount of households that could buy a Marley Spoon box today as we speak. We can serve this out of just 6 facilities worldwide, 3 in the US, 2 in Australia, in Melbourne and Sydney, and 1 in Europe. So this is a big advantage compared to supermarket. But the biggest advantage is really the concept of food waste, which many people are not aware of and underestimate, but in fact, up to 30% of these fresh products you see in supermarket shelves are just thrown out. 30%, which from an environmental perspective, I just saw today, 25% of CO2 emissions are generated by the agricultural sector. 6% of global CO2 emissions could be reduced if you would reduce food waste. Now, Marley Spoon, as we are not a retail business and as we source to order, our food waste is not 30%, actually less than 1%. We don't have any food waste. So we have a 30% margin advantage compared to supermarkets because trust me, the waste that supermarkets have, somebody's paying for that. And that's the consumer. This is marked up on the prices. So we can compete with supermarkets, but we have this big advantage of having no waste, which creates strong margins, which we'll see in a second. Is one of the exciting features about our business model. Now, when you think about the overall competitive environment, I mentioned supermarkets, which is really the core competitor, the grocery industry, the core competitor. There's also other ways to cook and eat during the nights, like delivery service, Uber Eats, Deliveroo, Menulog. And what we see is our customers, while they also order pizza here and there, they don't want to feed the pizza 3, 4, 5 times a week. What we see actually is that delivery services, on average, they serve our customers 1.5 times per month, roughly, often on the weekends. In fact, the biggest takeaway day normally is Sundays. Now, Marley Spoon, what we see is our customers cook on average 4 to 5 times a week, and they like to cook with us on average 3 times a week. So while we can serve every evening during the week to our customers, there's a big chunk that we can serve to our customers. So what we really see is we do not compete with an Uber Eats or Menulog. This is really more adjacent behavior. We do directly compete with supermarkets, or put the other way around. An average Marley Spoon customer spends 240 Australian dollars every month with Marley Spoon. Now that money used to be spent with Woolworths and Coles. What we see is once that's shifting to us, it actually sticks with us. And over a long period of time, customers actually get used to having us as the service provider for weeknight cooking. And then milk, cereal, breakfast, other things, of course, they still go to supermarkets. So we see really a shift and a switch over from supermarkets over to us. Now, let's think about supermarkets, and I want to come to that back later and talk about coronavirus impact. What's interesting about groceries in general is not just that it's a very big category. In fact, it's the largest vertical of consumer spending if you forget about the rent or mortgage. But it's also the last vertical to switch from offline to online. So we've seen in many other verticals, electronics, fashion, travel, switch to online between 20 and 40%. So this shift has happened over the past 15 years. Now, groceries, this is just starting. We're seeing globally around 3% of groceries having switched online. So it's a massive category, but it's just really at the beginning. I always say we're day one in this shift of demand regarding online groceries. Now, let's talk a little bit about where the company was as of the end of calendar year 2019. We had our roadshow 3 weeks ago. I was lucky to, at the very end, on March 13th, still make it back to the US from Melbourne. But let me tell you a little bit about where the business is at, and then also what we see today. Now, the business at the end of 19 was a 130 million euro business. So in calendar year 19, we generated 130 million euros in sales. So roughly a 230 million Aussie dollars run rate revenue business. The business was fast growing. We exceeded guidance. The business grew 41% year over year. And the majority of that growth and revenue is coming from repeat purchases. I'm showing that in a second. So the business is growing. It's also not growing, but also generating better margins. So we see improved contribution margin. We increased our margin by 4 points year over year from 21 to 25%. And actually, we exited Q4 already at 28.6%, which all regions contributing. So we see a very strong development of not only top line growth, but also margin growth, which of course leads to improved EBITDA performance. The business in 2019 was not profitable. We were still loss making in 2019 as the company continues to grow. It is profitability in its sight, and we'll talk about this in a second, but year over year we improved from a loss from 20 million to minus 12 million, or it's a 20-point improvement year over year. In fact, in Q4, we generated a record operating EBITDA performance of a loss of 2.4 million, or just 7% of revenue. So you see as top line grows, losses decrease significantly. And actually our Australian segment has been already profitable. Australia was profitable in the second half, was profitable in the second quarter last year. So you see overall that Australia is kind of leading the way that we also see in the other regions, with US being on a similar trajectory where we improved EBITDA as a percentage of revenue by 23 points year over year. So we see overall that this business, as it grows rapidly and improves margins and has strong unit economics, so profitability on a per user basis continues to be actually quite interesting and exciting. But as the business now top line grows, it also grows into profitability on a top line basis while showing continuous strong growth. Now, as I mentioned, the majority of that growth is because of the high quality backbook of loyal customers. That's really how business works. 92% of our revenue comes from repeat customers. And if you look at these, for example, 3 million boxes that we shipped in 2019, and you try to understand the maturity of these boxes, are these just first-time trial customers, or what is that? Well, if you put an order number next to each of those boxes, you will see that 64% of these boxes that we shipped, of those 3 million boxes, were order number 6 or higher. So the vast majority is really part of this solid backbook, and that actually increased by 6 points year over year. So 18 versus 19, you saw that a bigger portion of our revenue is actually driven by these high loyalty long-term customers, and you'll see that continuously improve and develop as we go forward. So you can see this also going forward. So please look out for this metric also in the future. So the business is growing based on strong customer loyalty. The business is a global business. We operate in 3 regions: Australia, US, and Europe. With Australia and US roughly 40% each in sales, and then Europe at 20%. Business growth in 19 came primarily from Australia and the US, but we'll see also in 2020 growth, not only in Australia and US, but also in Europe. So I think overall, we see pretty strong setup that we have generated in 2019 that sets up us well for what we're seeing currently in all our markets, actually. So the business is growing across the regions, primarily driven in the past by Australia and the US. And also from a margin perspective, I mentioned this earlier, I think it's pretty interesting that given the relatively small scale that we are, how strong these margins are already. It really speaks to this unfair advantage that we have compared to supermarkets, that we don't have any of the waste, and we have this 30% margin headwind. So in fact, our margin, contribution margin last year was trending towards the 36% in the fourth quarter in Australia, or mid-20s in US and Europe. And by the way, this includes all the fixed costs. So that's why we started to disclose also operating CM, which gives you a better understanding, given that we're relatively small in scale. So all these facilities, all the fixed costs we have, if you take that out to understand the marginal contribution for every incremental sale, you see that US and Europe is already above 30%, and Australia already above 40% in contribution margin at the end of last year. So I think it speaks for the business model that it has these high margins that we generate. So if you then try to understand a little bit where the company is coming from and where we are from a top line perspective, business keeps growing, but as the business grows and as the contribution margin expands, the EBITDA performance improves every half year. In fact, from an EBITDA perspective, we developed from a minus 39% operating EBITDA margin to minus 28% to minus 18%, exiting in the fourth quarter at just minus 7% operating EBITDA margin. So see, as the business scales in top line, as CM expands, as G&A is relatively flat. In fact, it has been flat for the past 2 halves, and we don't expect significant increases of G&A also going forward. You see that the business trends towards a more profitable outlook, which when I come to the outlook and the guidance, and this is now pre-corona, and I'll talk a little about in a second what has changed, but what we guided in January was that we expect that the business in 2020 will continue to perform solidly and show robust revenue growth. We guided 30% growth in calendar year 2019. We guided the contribution margin will expand similar as we've seen in the past, so 3 to 4 points on a year-over-year basis. We guided that operating EBITDA performance improves every half year, not just as percentage of sales, but also in total number of operating EBITDA losses come down. And we guided that the company will be profitable by the end of 2020. So that's kind of the starting point that we saw before the world changed completely. And to us, really, the world has changed. So I want to show 2 slides conceptually what we see, what I believe we see is happening right now. As I mentioned earlier, what we think with groceries is really at the beginning of adoption. And if you compare this with many other verticals, we're probably at this 3% adoption rate offline to online when it comes to groceries. So most people buy the food in supermarkets. However, I never doubted that 3% is not what the natural state of online adoption for groceries is. All the other categories have 20, 30% adoption rate. There's no reason why supermarkets should be not in the same range. Now, nobody knows whether we'll see 20% or 30% adoption rate, but for sure, we'll see more than 3. So this is the situation that we've seen expanded. Now, I think this has just happened, what you see here. We've just seen a gap up in adoption. And it happens in all our markets at the same time. In fact, I flew in on Friday from Melbourne to New York. On Friday, we saw a surge, an unprecedented surge in demand in Europe. Over the weekend, we saw an unprecedented surge in demand in the US. And on Monday, it started in Australia. So what we have is suddenly all these people being at home, hundreds of millions of households being subject to lockdowns. And suddenly, they don't want to go to the supermarket anymore. They want to make sure the food comes to them, which makes total sense. And obviously, if the industry is there to serve 3% of demand, and the demand now goes doubles or triples or quadruples, whatever the demand is, nobody can fulfill it. Woolworths can fulfill it, Coles can fulfill it, we can fulfill it, HelloFresh can fulfill it. In fact, HelloFresh switched off the acquisition funnel. So what we see today is that people just want our products, and because they're home, they don't even care when they get the product. It used to be that people wanted the box on Mondays. Well, now they're home 7 days a week, it doesn't matter when they get the box. So we see suddenly an increased demand that people just want the product, and that means acquisition costs, they just plummet down, they drop down. They go close to 0. In fact, and you can see that when you Google, and there's also with our competitors, everybody switched off marketing. Nobody switches on marketing, and still we see a big influx of customers. So we don't pay for those customers that come. Now, nobody knows how long will this happen, what will happen when things change again. Will it last 2 weeks or 4 weeks or 8 weeks, like in Wuhan, 12 weeks? We don't know. Will restaurants open up again, or will we have 12 months of people being unsure about being in big crowds and they'd rather be at home? Nobody knows that. What we do know, though, is if customers get used to a product, especially our product, and they use it 5, 6 times, they create a habit. In fact, if you use Marley Spoon 6 times, even pre-corona, the likelihood for you to stick with the service is more than 96%. So you build a habit over time, and I believe we are able to train people's habits. And we are not just creating an unnatural demand, it's a gap up in a natural development. We kind of press the time machine and we just fast forward in adoption. And that's what we're seeing today. Now, what does it mean to us? That's the same slide I just showed earlier. As you know, we left the fourth quarter with a 7% operating EBITDA margin loss, but we spent 24% of sales and marketing. So when you think about that, that's a big chunk of sales going to marketing, and if marketing goes down dramatically, goes to 0 or above 0, who knows? Nobody knows. But it comes down dramatically. You see that has a big impact on profitability. Of course, top line growth is another big contributor, because as top line grows, you've got the base cost leverage effect. So G&A improved from 34% to 24% over the past periods. Now, as I mentioned before, we think G&A is kind of where it will be and need to be. We didn't increase G&A for the past 2 halves. If we just would hit the guided revenue growth of 30%, which, by the way, we already were above in the first quarter, which we guided last week when we gave an update, that would come down to 18%. So 6 points just on G&A as percentage of sales. But if you exceed that growth, this comes further down. So I think what we're seeing really is that for us, from a unit economic perspective, acquisition cost versus lifetime value, acquisition costs come down and lifetime value is actually improving. Not only because we get free customers in, but also existing customers suddenly come back more often. They don't skip as often. They want more meals per week. So it's like a perfect storm is the wrong word, but we really see a tremendous demand for our products and a tremendous responsibility also to fulfill that demand, because we are here and we can do something and help people while they're at home. So if you look at the summary and the outlook, and again, this is an old slide from 3 weeks ago. Now it's old, but I think I can comment to that. So you'll see also in 2020, the business will continue to grow fast, probably more than those 30%. And that growth is driven from all regions, and it's driven from all regions probably at much lower acquisition cost. You see also existing customer behavior being extremely loyal, and that's helping us, of course, in the overall growth business. The business will continue to improve operationally. And now when it comes to our EBITDA and profitability guidance, we haven't given up our new guidance, because these days nobody can guide to anything. But you probably can do the math on the back of an envelope that I tried to signal a little bit. There is a very positive input right now, or positive effect on the performance of our business that we're seeing here. So that will, of course, have a positive impact also on the profitability profile of the company. In any case, we believe we're still in day one in this adoption. So even now, as we scramble to increase demand and maybe double capacity as quickly as we can, even then, we believe this is still a relatively small business when you think about the massive scale of groceries. Anyway, so this may be some of our feedback. I think we might have 5 or 10 minutes for some questions, if there are some questions.
Yep. Fabian, which region has seen the largest increase in sales during the COVID-19 crisis so far?
Sorry, I couldn't hear that question.
Sorry, which region has seen the largest increase in sales during the COVID crisis?
We see the same surge in demand in all regions, to the point that we switched off marketing currently, and this can change any time, but currently we switched off 98% of all marketing in all regions. So it's kind of hard to see what's the growth. The growth is not really a question of demand like in the past. The growth becomes a question of creating capacity. And we are hiring right now hundreds of people all over the world to actually start meeting that demand. So my problem is I can't guide at this point in time how quickly and to what extent we can create capacity. The good news is that in the past, we used to manufacture everything on 1 or 2 peak days if everybody wanted Monday delivery. And now we have the opportunity to smoothen out and increase utilization of our sites without actually going CapEx. We can actually very quickly, with labor, do a lot in creating capacity. And that will then in the end tell us where we can grow. In theory, we could grow in all regions much more than we have capacity.
Will you now be profitable before the end of CY20?
We said in the past we'll be profitable by the end of CY 2020. And again, and now nobody knows what CPAs will do and what marketing spends will do. And nobody knows how much we're going to grow. But this gives you probably a good perspective on what needs to happen for the business to become profitable and how quickly could that happen.
Sorry, next question. Can you clarify more recent trades in churn rates, CAC, and whether large jumps in unemployment are a headwind?
So CAC has come down. We haven't disclosed any CAC because it doesn't really make sense. We see really in certain days and channels CAC of 0. So it's really, but this is just the point of view as of today, and it can change. So it's very hard to say, but there's 2 reasons why I'm quite confident that CAC will come down. First of all, right now we don't pay anything for acquisition, but also if we were to go back into and change, so it's very hard to. There's 2 reasons why I'm quite confident cratering right now, similar as we saw 2008 and 2009, because travel doesn't buy any ads anymore, and hospitality doesn't buy any ads anymore, consumer discretionary doesn't buy any ads anymore. So suddenly CPMs just come down dramatically. You can get free TV spots today, and we just can't. We don't want them because we can't fulfill demand. But it's, even if we were to the point that we are very successful in creating demand and we want to start to communicate again to customers about our products, I would expect CPAs to come down dramatically. What was the second half of the question again? I think it was some questions around headwind.
And just the last question, Fabian, what is capacity utilization in each region of production facilities?
Yes, so capacity utilization prior to Corona was very similar in every region. So we normally, out of 7 weekdays, we normally tend to, or we used to manufacture 5 days of those 7 days, with 2 days being off. And of those 5 days, 2 days used to be peak days where we had very busy 8-9 hour days where we produce a lot of boxes. The majority of our production, as most customers want their boxes on Mondays and Tuesdays. So you could argue, if you move in theory, and this is just theoretical exercises, if you go from 5 production days with 2 peak days to 6 production days with 6 peak days, so just really utilize the whole day, you can kind of double capacity. It means you're at 50% capacity. Now, if you now go to 2 shifts every day, in theory, you could double capacity again. That means right now in the past, we would operate in a theoretical capacity of 25% of capacity. So this is a theoretical example that shows what is in theory possible. Now, going from 2 peak days to 6 peak days and then going to 2 shifts is a lot of organizational challenges. Hiring not only associates, which these days is very easy. We are actually being flooded with people that are looking for work, which is great for us to build our teams. But we're also looking for team leads. Is a lot of for a management position, so we can organize and manage these shifts. And at the same time, we have to keep our teams safe and healthy. So we have social distancing processes in place that also require workforce and sort of restrict us sometimes. So it's really hard to say as this is a 2-week situation that we are in. The whole team is hands on deck, scrambling. Everybody feels excited, but also proud that they can do something and feels the responsibility to provide healthy and safe cooking and groceries to our customers. So it's really hard to say at this point in time, as it's so fresh, what is the capacity that we can create and we run on in theory. Really in theoretical perspective, I think you could go up to cooking and groceries to our customers 4x, but that's a very theoretical number. So I would more like say, if you can double capacity in Q2, that would be already great news. And so that's kind of my thinking that the team is trying to execute against. And that's not guidance at all because we just don't know. It's very new and everybody's scrambling. We're trying to do as good as we can to meet our customers.
But we might have to wrap it up there just because we're about to start the next one. But thanks so much for taking the time. I know it's late in New York. Stay safe. It's scary out there, but business looks like it's absolutely flying with tailwind. So thanks very much for your time, and we'll catch up soon. For the questions that we didn't answer, we'll come back on the email. But thanks very much. Cheers, guys.